So where does the interest go when I am repaying a loan on a cash value life insurance policy? Some who have read Becoming Your Own Banker or Bank on Yourself, or I should say many over the years, have been under the impression that when you pay a loan back, whatever the loan interest rate is on the policy goes back to yourself, which is actually not the case at all. So for example, if I have a policy that has $100,000 in cash value, and I decide to loan out half of it, just to simplify. Let's assume that the loan interest rate with the life insurance policy I have is 5%. What would happen here is how a life insurance policy works is I often have a dividend rate. I always have a guaranteed rate, but likely a total dividend rate that is applied to my full cash value. If I take a loan of $50,000, that dividend is still applied to the full $100,000 as if I never touched it in the first place. So money that I borrow continues to yield dividends. There's no loss of compounding on my money. Now, when I have a loan outstanding, if it's 5% or whatever the rate is that is determined and billed by the insurance company, guess where that goes? The insurance company, not back to myself. So if we have read any of these books, or if we viewed content online, PDF, websites, videos, whatever it might be, and we've seen or heard the phrase or saying, pay the interest back to yourself, take a loan out and then you pay yourself back with interest, what this means, to break it down a bit, is this. If I have a 5% loan, we'll see both of these books actually, take a loan and repay it at 10%, for example. If we are repaying a loan at 10%, what that would mean is of that payment, 5%, the loan interest would go to the insurance company. The other 5% would go into our PUA rider, which another way to put it, a cash dumping. We're accelerating the cash value growth of the life insurance policy. Okay, let's demonstrate this real quick. So we're going to look at really how loans work here. We're going to look at an example where we fund a policy, let the money sit and grow, and then compare it with the exact same policy, but when we take a loan and repay it, we're specifically going to focus on how the loan interest works. What am I paying? What am I receiving? So on our growth study, 50 for 5 years, this number could be 5,000 or 500,000, does not really matter. 150,000 in year 3, 150,000 in cash value in year 3, break-even point. Take special note to this dividend column, especially when we compare it with the loan example. Okay. Now, on the loan example, we pull out a $200,000 loan in year 5. We can take loans anytime we want. The gauge determining how much we can pull is our cash value. Think of it this way. That's the equity that determines how much money you can borrow from the life insurance policy. We borrow $200K. The insurance company will collateralize your death benefit dollar for dollar. You will see when you pull out a $200K loan, your death benefit reduces dollar for dollar, a $200K reduction. Okay, now our cash value reduces by $210,000. So where'd the extra 10K go? Well, we deferred payments for a full year here. 5% of 200,000, that's the loan interest rate here, 5% is 10K. So in the first year, the first loan year, it technically borrowed another 10K from itself. Now, as we begin to repay it, at 50K per year, which it does not have to be 50K per year, it could be anything. Here's what I want to tally up. You've got your loan interest column. You pull out 200. What do those repayments equate to? 200 plus another 28,975. That extra 28, call it $29,000, was interest that went to the insurance company, not back to ourselves. So where this makes sense is when we look at the total, or at the end of the repayment cycle, year 10, what do you notice in the example when you let it sit and grow compared to the example when you borrow and repay with the cash value and death benefit? Fully restored. There's no change. Now, when you look at the dividend columns on the growth example, letting the money just sit and grow, and on the loan example, when you've pulled the money out, when you pulled that $200,000 out, do you ever see your dividends decrease? Do you see a slowdown in interest there? No. The reason why is even though you borrowed $200 against it, the company collateralized your death benefit. They charged interest on the $200K, but continued to pay you dividends on the entire bucket of money as if you never touched it in the first place. This way, when it's repaid, everything's fully restored to exactly what it would have been as if we never touched it in the first place. And this is the case if we pay it back like clockwork, a lump sum, or sporadically over a long period of time. Now, if we practice paying ourselves back with extra interest and throw more money into PUAs, what we would be doing then, in effect, is adding more money into the annual outlay, the payment section, which would then enhance our overall cash values, especially when the loan's repaid. We see it's just like I added more money without a loan. So hopefully you found this helpful. Any questions, or if you'd like to see any samples, feel free to reach out. Hey guys, Steve Parisi here. If you enjoyed the content you just saw, please subscribe, like, and hit the notification bell for future videos. If you'd like more information or to see some custom policies for yourself, feel free to call or email our offices at the contact information below.